Hello and welcome back to our third lecture video dealing with variable costing and segment reporting. In this video, we're going to go ahead and look at how do we reconcile the difference in net operating income between the variable costing method and the absorption costing method. And we're going to explain why those two amounts differ. Up to this point, you probably should have a good idea of why they differ, right? We said as soon as we started this chapter, hey, the difference between absorption costing and variable costing is how we handle our fixed manufacturing overhead. Variable costing says fixed MOH is expensed as soon as it is incurred. Under this variable costing method, fixed manufacturing overhead never becomes part of the product cost. Under the absorption method, we said that, okay, variable and fixed manufacturing overhead are part of the product cost. Under the absorption method, that fixed manufacturing overhead, we only recognize when we sell the product. So let's go ahead and really jump in here and get a look at why we do what we do, okay? So we're comparing the two methods here, right? We're looking at our cost of goods sold. Now, I'm hoping that this looks familiar, right? Because it is the income statements, or let me rephrase that, the numbers that we used from the previous income statement, or the previous video when we put together the income statements. So notice the absorption costing, right? We have variable manufacturing overhead at $200,000. Yep, that's normal. We have the fixed manufacturing overhead expense of $120,000. That's how we got our total cost of goods sold to be $320,000. Under variable costing, we says, you know what? Variable costing only includes variable manufacturing overhead as part of its product cost. What happens to those fixed manufacturing overhead fixed manufacturing overhead costs under variable costing? Well, they become part of our period cost. They are expensed as soon as they're incurred. Okay, so let's go back to that absorption costing and let's see how that total fixed manufacturing overhead of $150 or $150,000, excuse me, how it looks under absorption, meaning where's it at? Well, we know that the fixed manufacturing overhead per unit is $6, right? We already determined that and figured that out back in video 1. So what we're saying is that $6 per unit, we're going to apply it to both cost of goods sold and ending inventory, right? Why? Well, because remember, we recognize our product costs when we sell those products, right? So that means that we sold enough products to recognize fixed manufacturing overhead of $120,000, right? Well, we know in total we have $150,000. Well, where'd that $150,000 of fixed manufacturing overhead go? It's sitting on the balance sheet in ending inventory as $30,000. When will we recognize that? We will recognize that $30,000 of absorption costing whenever we sell those units, which will probably be in the next period. Okay, so this slide here really gives us a visual representation of what happens to fixed manufacturing overhead costs under the absorption method. We recognize the amount that we sell in that period, the amount of fixed manufacturing overhead that we do not sell does not get recognized as an expense. It sits on the balance sheet in our ending inventory account until we sell that product. Then we recognize the expense. Variable costing says we don't care when we sell the product. It's a fixed manufacturing overhead. Because we're doing variable costing, fixed manufacturing overhead gets treated as a period expense or a period cost, okay? So let's look and see, how do we reconcile the differences between absorption costing and variable costing, okay? The first thing we're going to start off with is what is our variable costing net operating income. If you think back to the previous video, we already identified that the net operating income under the variable costing method is 90 grand. Great. To that, we need to add fixed manufacturing overhead costs that we deferred to inventory, meaning that fixed MOH that we didn't recognize. Where is it? It's sitting on the balance sheet under finished goods inventory account, okay? 5,000 units times $6 gives us our 30,000. We're going to take our variable costing net operating income and add the fixed overhead that absorption costing defers. We end up with our absorption costing net operating income of $120,000. That's how we reconcile, okay? Key is start with the variable net operating income, add any fixed MOH that was deferred in inventory. You add the two together, you're going to come up with your absorption costing net income. If you didn't, you got a problem, okay? But the takeaway here is, one, knowing how to calculate it. Two, recognizing that if you don't reconcile the difference, we probably made a calculation error in that fixed MOH that we defer. Okay, so let's take another look. Okay, and let's expand this concept. Right, look what we have here. We produce 25,000 units. We sold 30,000 units. How is that possible? It's possible because guess what? We have beginning inventory. We see that we have units in beginning inventory of 5,000. They give us the unit sales price, 30 bucks. Great, nothing new here, right? They give us our variable cost per unit, the direct material, direct labor, variable MOH. They give us the variable selling and administrative. They give us the they give us the fixed portion of the MOH and the selling and administrative costs. So, step number one, calculate your unit cost under both absorption and variable. Remember, what is the main difference? The main difference between absorption and variable costing, I know I'm sure some of you guys are rolling your eyes like, why do you keep saying the same thing? The idea is to kind of just get that into your long-term memory. So the difference between variable costing and absorption costing, again, is how do we handle the fixed manufacturing overhead. Variable costing says we do not include fixed MOH as part of our product cost. Absorption costing says we do include fixed manufacturing overhead as part of our unit product cost. Okay? So notice what our unit product cost is, we have 16 and 10, right? How do we get that? Well, absorption costing, we say DM, DL, variable MOH. To that, we add the fixed manufacturing overhead cost per unit, which is $6. How did we get that? Very, very easily. We took the total fixed cost, we took the fixed portion of the MOH, which is 150,000, and we divided it by the units produced, 25,000, okay? Next, we go ahead and we say, okay, let's put together the variable costing income statement. You should know right off the bat, we got to use the contribution formatted income statement. You know that the variable cost of goods sold is calculated by the number of units sold, 30,000, times the variable manufacturing unit cost, which is $10 per unit. We get 300,000. Now we're doing the contribution formatted income statement, so we got to include the variable selling and administrative expenses, which are 90,000. We end up with total variable expenses being $390 or 390,000. We subtract those total variable expenses from our sales. We get a contribution margin of $510,000. Then we subtract out all of our fixed expenses. We include fixed manufacturing overhead. We also subtract out the fixed selling administrative. Notice what our net operating income is, $260,000. Okay, cool. Now let's do the absorption costing, right? Nothing new here. How do we calculate the cost of goods sold? We take the number of units sold, 30,000, times the unit product cost under the absorption method, which is $16. We end up with cost of goods sold being $480,000. We subtract the cost of goods sold from the sales to get the gross margin of $420,000. Then we subtract out both portions, meaning variable and fixed, of the selling and administrative expenses. Those are period costs, right? Notice our net operating income under the absorption method is $230,000. Under the variable costing method, it was $260,000. Well, wait a minute, what's going on here? Previously, we found out that absorption costing had a higher net operating income. Now you're telling me it has a lower net operating income? How is that? Well, it all has to do with the fixed portion of manufacturing overhead, right? Remember those 5,000 units that were sitting on our balance sheet? Guess what? We're now at the next period. We now sell those. We now have to recognize that expense. So fixed manufacturing overhead released from its inventory $30,000. Okay? How do we reconcile? Start off with your variable costing net operating income, $260,000. Now we deduct any fixed manufacturing overhead costs that were released from inventory. We release $30,000 of cost. We subtract that from our variable costing net operating income. We end up with, or we reconcile to the absorption costing net operating income of $230,000. So what we're seeing here is that from one period to the next, in total, our costs are equal, right? They're $350,000, right? But notice the costing method that we use compared to the first period and the second period. First period, the absorption costing was higher, right? It was higher because we deferred some of that fixed manufacturing overhead. Under variable costing in the first period, we expensed the whole thing, $150,000. Under period 2, under the absorption method, we released some of that fixed manufacturing overhead that we had previously deferred in the first period. Now we're in the second period, we're releasing that, right? Variable costing says, hey, guess what? We're only subtracting the fixed manufacturing overhead of the second period, which is $150,000. That's the main difference. Now, this slide right here, extremely important in understanding what's going on here. What are we doing? Okay. I'm also going to reference in the book here. If you have your book handy, if not, that's okay. Just jot it down. If you look at Exhibit 6-5 on page 265, I'll say that again, even though it's a video and you can rewind. Exhibit 6-5 on page 265. Okay. There's a relationship between the production, meaning the number of units we produce, versus the number of units we sell. Okay. If the units produced equal the units sold, meaning we produce 20,000 units, we sell 20,000 units, we have absolutely no change in inventory, meaning there's no effect on inventory. Okay? Whatever we make, we turn around and sell. Under that scenario, there should be no difference between absorption costing and variable costing. Okay? Where we get into the thick of things is when we produce more or less than what we actually sell. Okay? So let's look at the middle line there. It says, okay, the units produced, if we produce more than we sell, our inventory costs go up. So that effect on inventory, meaning the value of inventory increases. Why does it increase? Because under absorption costing, we produce more than we sell. That means the fixed manufacturing overhead is deferred to the next period. That's why the inventory value increases. Well, what's that relationship on net operating income? Well, the absorption method is going to be greater than the variable costing. Okay? That was the first example we saw. Then we look at the second example. What happens if the units produced are less than the units sold, right? Meaning we produce 25,000 units, but we actually sell 30,000 units. Our inventory decreases. Why? Well, because we only produced 25,000 units, we sold 30. That means we took 5,000 units from our inventory account and sold those. Okay, so the value of inventory decreases. When we produce less than we sell, our absorption costing, or our net operating income under absorption, is less than our net operating income under the variable method. Okay, very important concepts. If they're as clear as mud, reach out to me. Be happy to have a discussion with you. Okay? Now, hopefully you picked up on the fact that variable costing utilizes the contribution formatted income statement, which we used in Chapter 5 to do CVP analysis, cost, volume, profit analysis, okay? So because variable costing categorizes our expenses based on behavior, meaning fixed or variable, it's so much easier for us to use the contribution formatted income statement for CVP analysis, okay? And again, absorption costing assigns fixed manufacturing overhead costs to the units produced. Very important we understand that, okay? That means that a portion of the fixed manufacturing overhead cost is always going to be in inventory when units remain unsold, okay? The benefit of this, or the result, is that we're going to have a higher or a positive operating income when the number of units sold is less than the break-even point, okay? So, how do we explain these changes, right? Very simple, okay? We already did it. It has to do with the fact of how we handle variable, or how we handle fixed manufacturing overhead, and looking at the number of units produced versus the number of units sold, okay? So variable costing income, it's only affected by changes in unit sales, okay? It's not affected by the number of units produced. Very important we understand that. So we're going to have kind of a general rule here when looking at variable costing. When our sales go up, net operating income goes up as well. On the flip side of that, looking at variable costing, when sales go down, net operating income is also going to go down, okay? Absorption costing. Remember, this is influenced by changes in the units sold and the units produced, okay? So net operating income under the absorption method can only be increased, can be increased, right? By producing more units even when those units remain unsold. Okay? When we come back in our next video, we're going to kind of jump into the next topic of this chapter, which deals with segmented income statements. Okay? We have a company, and within this company, we produce two different lines. We do shampoo and conditioner, or we do shoes and socks, or we do weed killer and flower fertilizer. So tune back in and we'll look at that example.